It wouldn't take much on the upside over the next few weeks even, where silver gains a bit to gold, and it will break out on these technical metrics of the measuring the relationship between the two. And I would bet that that would probably coincide with gold one being back to and through its highs, 2,800, but silver also back up to its highs, 35. At that point in time, silver's still cheap to gold. I mean, like you said, gold's way over its 2011 high and so forth. Silver's not above its dual highs at 50. I think it's the next move that's likely to blow that stuff out. And I don't think 50 is a target, by the way. If we get going in this next leg, and I think we will, stock market being a key factor, that $50 is just it's a paper target.
Silver remains undervalued compared to gold, with its price yet to surpass previous highs of $50, unlike gold, which has already exceeded its 2011 peak. If silver gains relative to gold in the coming weeks, it could trigger a technical breakout, likely coinciding with gold surpassing $2,800 and silver reaching $35. However, $50 is not an accurate resistance level. Once silver's next major rally begins, it could break well beyond that, especially if broader market conditions align. MichaelOliver, a renowned financial analyst, explains that gold and silver cannot be analyzed in isolation, as broader financial markets, central bank actions, and money supply growth influence them. When the stock market declines, capital flows into safe haven assets like gold, which has already outperformed the S&P 500 despite being largely ignored by mainstream financial media. A deeper stock market downturn could accelerate this trend, causing gold to rise further while paper assets weaken. Silver, meanwhile, remains historically undervalued relative to gold, indicating a potential major rally. Michael highlights that if gold surpasses $2,800 and silver reaches $35, silver could break through its long-standing $50 resistance level. However, $50 is not a true ceiling. Once momentum builds, silver could surge toward $100 or higher, with technical indicators suggesting a possible mid-$60s range before pausing. A stock market breakdown, particularly in major indices like the S&P 500 and Nikkei, would likely trigger aggressive central bank interventions, further driving demand for precious metals as confidence in fiat currencies erodes. Join us as we explore these insights in the video. If you find the content valuable, give us a thumbs up and subscribe to our channel for the latest updates.
It's been our pivotal point in our reports because we look at all four major asset categories. We don't just look at gold and silver. You can't do that. They're impacted by other markets that impact central banks, that impact the growth in money, et cetera, et cetera. So they're all tied together. And when you break the stock market, I think that's when you will start to see the verticality, which we've already seen some pretty good stuff. You know, if you stand back and look at it, ignore the zigzags that always occur. Gold, for example, last year closed at 24, closed at 23 to close at 24, was up more than the S&P. Silver matched basically the S&P. Nobody cheered that. It wasn't on the major financial channels. It was all stock market. So they've ignored that reality. And I think you'll start to see a further separation where gold continues up and its related markets, and the other paper assets start to bleed. And when they bleed, that money goes somewhere. Now, as far as silver versus gold, it's dirt cheap off the page. We know that, historically speaking. Now, it's either fundamentally lost any rationale for being, okay, which we know isn't true, or it's an error. Silver's just priced too low. These things happen in markets. Markets get priced too high and they pay the dues. Markets get priced too low for so long and they go up, and you hardly need an excuse. It's just that they were underpriced for too long. And I think silver's in that category. Technically, we can measure the spread relation between silver and gold. And I've got some numbers that we're monitoring that wouldn't take much on the upside over the next few weeks even, where silver gains a bit to gold, and it will break out on these technical metrics of the measuring the relationship between the two. And I would bet that that would probably coincide with gold one being back to and through its highs, 2,800, but silver also back up to its highs, 35. At that point in time, silver's still cheap to gold. I mean, like you said, gold's way over its 2011 high and so forth. Silver's not above its dual highs at 50. I think it's the next move that's likely to blow that stuff out. And I don't think 50 is a target, by the way. If we get going in this next leg, and I think we will, stock market being a key factor, that $50 is just it's a paper target. You know, everybody's looking at it, but you'll blow it out. You'll go well up in between there and 100 or something. You know, I've got some reasons to think the mid 60s before you even stop for a pause. But the key right now is that what happens in this current situation. Break that stock market. Break the Sensex. Break the Nikkei. And you'll have central banks go berserk. And we know what wins when they go berserk.
In an interview at Commodity Culture, Michael exposes that silver miners are currently undervalued relative to gold and historically cheap compared to the S&P 500. The Philadelphia Gold and Silver Miners Index XAU, which tracks mining stocks, has significantly underperformed gold since the 2008 financial crisis. However, since bottoming in December 2015, the miners have kept pace with gold's gains despite the perception that they have lagged. This suggests that while the sector has been suppressed for nearly a decade, it is poised for a potential breakout. A key technical indicator is the spread between the XAU index and gold, forming a long-term base. If this spread reaches even the lower end of historical ranges, gold miners could outperform gold by 3 times or more. With the spread currently around 5% and historical resistance near 18%, a move higher would signal a significant rally in mining stocks, making them an attractive opportunity in the precious metals sector. Now let's jump into the interview.
Historically speaking, go back 20, 30 years, you can look at the relationship between them. And also the gold miners as a subsector of the stock market are off the page cheap compared to the S&P. But that sort of hides the truth. The top chart shows the XAU index, which is the Philadelphia Gold and Silver Miners Index. It's been around a long time, since the 1980s, so this is why we use it. It's got a lot of history. And when you look at that spread chart versus gold, you'll see that the spread relationship between XAU and gold, and what we do to measure that is we measure the price of XAU divided into gold expressed as a percent. And so back in the 1980s through 2008 or so, XAU index was trading at 25, 30%, even got up to 38% of the price of gold. No, XAU versus 1 ounce of gold. And the lows were around 17, 18%. Meaning whenever you get a dip and the price of XAU dropped to about 18%, it would find support. And so in that top chart, you'll see there was this range at a high level. But in 2008-9, just prior to the onset of the gold bear market, the spread broke, where the miners started to break in relation to gold, and their performance collapsed down to when? To the December 2015 low. So the spread, in other words, the lessening performance of the miners versus gold, dropped until gold and silver and miners actually made their price low, which was December 2015. But if you look at that spread chart, you'll see that over the last 9 years, since late 2015, the spread has gone sideways. Yes, at a very depressed level, but it hasn't gone down anymore. Now, you say, well, that's a dog. Well, actually not. Right now, the spread is a little bit higher than it was at the close of December 2015. Now, what does that say? It says that miners have been a par performer, sideways performer to gold, meaning they've gone up just as much as gold has during the last 9 years. You tell the average investor that and he'd chuckle, but it's a fact, measurable fact. The miners have matched the gains in gold. The question is now, when do they break out? And you can see I've plotted a 3-point downtrend line on that spread, but there's also this basing range of 9 years. I think we're going to break out of this range. And we measure various things to determine when that's occurring, not just this spread chart. But when you break out, look at that line overhead on the spread. The old lows at about 18% over. That's resistance level now. It was support for years and years. If you break out now from where we are, you're likely to find resistance up there. But let me tell you, we're trading just above 5% now. That's a triple and more in the spread relationship. What that says is if that spread breaks out and you even just go to the bottom end of the prior multi-decade range, that means gold miners will have tripled the performance of gold in getting there. Okay?
As the financial landscape shifts, silver and gold and their respective mining stocks appear to be on the verge of significant breakouts. Historical trends and technical indicators suggest that silver remains undervalued, and mining stocks are positioned for substantial gains if key resistance levels are breached. With increasing economic uncertainty and central bank interventions, the demand for precious metals could surge, making this a pivotal moment for investors. How do you think central bank policies will impact the future performance of silver and gold? Do you believe mining stocks will finally break out and outperform gold in the coming years? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.